Well, greetings and welcome to the November Investment Strategy Brief. This month we've renamed it. We'd been focused so much on just COVID-19 and then the election. We've renamed it the 2020 election, COVID-19, and a way forward. So let's start with the election, though, just sort of take a snapshot on where we are at this point. It looks like while there's still counting going on and lawsuits, maybe recounts, that Joe Biden will win the presidential election. And so obviously a change there in that part of our federal government. We did see Congress, in the case of the House of Representatives, stay with Democrats. Democrats remain in control, but with fewer seats. And then some additional drama is really in the Senate, where the Republicans have lost some seats. Currently, they've secured 50, and there's a runoff in Georgia where there are 2 seats that are going to be subject to that runoff. And if one is won by Republicans, which is kind of the consensus view, then the Republicans will remain in control of the Senate. And so what that means is we're in a divided government. We've been modeling these different scenarios. And so in the case of this next slide, basically, just to sort of recap, we kind of look at a divided government as kind of neutral, meaning not a lot of change can happen. And so things turn back to the current sort of status quo and fundamentals in the case of the current environment, the pandemic, and how things are going there. So we're going to get into that. But if we look back at what was expected before the election, there was sort of an anticipation of a blue wave that the Democrats would win the presidency, the House, keep the House, and then win the Senate. Of course, that would have triggered a lot of change in terms of sort of a unified government that could get things done. But with a divided government, it's going to be a little bit slower. Things like a smaller scale fiscal package, things like taxes probably remaining kind of where they are, and less likely that we'll see tax increases. And so, things will sort of stay a little bit more status quo. Biden certainly can make some changes, especially those that are non-legislative in nature, more in terms of executive orders and maybe administrative rules changing to try to advance some of the things. In any event, as I mentioned, that means investors are going to focus back on fundamentals and on COVID. Now, when we look back to sort of the experience of the election, what was pretty interesting is early during the election, the day of the election, it looked to be a better day for Republicans. So think of it as the view that the Senate was really sort of going strong for the Republicans, and the presidency could be won by Trump. But as the evening and overnight, the time wore on and into multiple days after, it was pretty clear that sort of mail-in vote count that was the last to be counted was in the favor of Democrats, and in this case, Joe Biden, and the chances of him taking the presidency, as we've discussed, are much higher. Still, again, some things still being done in terms of recounts and lawsuits and whatnot. The markets, by the way, have responded very positively to this outcome. I think the takeaway was there was an observation, sort of a wonder about a blue wave. With a divided government, that means, again, the fundamentals are going to drive the market. The market, generally speaking, liked that. So we've seen a strong market since. Now, this next chart basically shows the average experience for the equity market, in this case, the S&P 500, when there's a change in the White House. So a party change in the White House. And what you see is some optimism where the market moves up, really to Inauguration Day, kind of turns down, and these are all incremental, but turns negative in a negative direction as that new administration comes in. Then there's a wave back up through May, down through July, and sort of choppy through the year. But I think an important takeaway is net, a positive return. So again, we'll watch things as things unfold. And of course, the fundamentals and the pandemic are really going to drive things from here. So let's get to a COVID-19 update. Unfortunately, we're really sitting here in what's been tagged the third wave of viruses around the world and here in the U.S. So this chart is basically a 7-day moving average of daily new cases. And if you look to the right on that line chart up above, basically you can see it accelerating up. And that's basically an increase in new cases. And the bar chart is showing the change in 7-day average of daily cases. So you can see even bars kind of squarely on the positive side, meaning that this virus is spreading. That's in turn led to an increase in hospitalizations, which is something we're all watching very carefully because we don't want hospitals to become overwhelmed. And then starting to see that all translate to additional mortality, so more deaths. And this is sort of not quite as dramatic, at least yet. On one hand, it's a little bit, unfortunately, of a lagging indicator. People get sick, they stay sick for a while, and unfortunately sometimes pass away. But also we think improved therapeutics and sort of the ability to treat the virus. And in fact, as I think everybody knows, the big news on COVID and the pandemic has really been over the last couple of weeks, a couple of very positive news items coming out of a couple different companies, Pfizer and Moderna. In both cases, the efficacy of their vaccines up above 90%, with a signal, in the case of Pfizer, for example, that they could go for emergency use authorization even late here in November. And so, again, everybody's watching this very carefully, and I would say the market is increasingly pricing in kind of pandemic resolution through a vaccine. Now let's turn to the macro environment. This page we always like to show is basically a lot of things that my team and I are watching. We've talked about the pandemic. We're going to get into market levels. We're going to get into earnings and the sort of the headwinds and tailwinds related to the pandemic, challenges that we're facing, and then tailwinds really around things like a vaccine. So we're going to jump into a lot of this information here. Now, one thing we want to acknowledge as we've come through the election is with the pandemic, what has been an unprecedented policy response. We've talked about that before. And while there was a little bit of a stall with Congress, the president actually issued some executive orders to continue some of the support. But as I think everyone knows, there was sort of the possibility of another fiscal package pre-election. That didn't pan out. Now we're sitting here with likely President Trump in a lame duck session. And essentially the question is, will we see a fiscal package before Inauguration Day or not? I would say the betting odds would say no. It's more likely to occur under a Biden administration. And by the way, because of a divided government, probably less than the Democrats had originally hoped for. That said, in talking to our sort of strategy analyst out in D.C., he indicates that even with that, we should expect to see some support for quote-unquote public spending like infrastructure in this next package. But again, we're looking at probably first quarter of 21 for that fiscal package. Now, I want to bring back to this discussion some charts that we've looked at in the past. And it's less about all the details on these pages and more of the colors and the patterns. So just to explain these again, these charts basically will take a data point, and the bigger box basically will plot typically 10 years of data. Of course, oftentimes it's looking kind of either cyclical or volatile. And then the smaller box zooms in on the last year. Then for each data point, we print the latest print, the number that you see associated with it, and we color code it. If it's deeper red, that's a problem. If it's green or deeper green, that's better, that's good. And so here with the consumer, what we know is that there's some things that have gone well in terms of recovery and others not yet so much. So the things that have gone well include essentially retail sales. So think of it as the activity of the consumer has recovered well. Unfortunately, unemployment, the idea of the job market, hasn't yet fully recovered. It's gone better than expected, but still, unemployment at 6.9%, still a significant number. I think it was 2013 the last time we saw this level. And then consumer confidence has recovered, but not quite back to pre-pandemic levels. So the consumer mixed to positive. On the housing front, I think we've all heard about this data. Generally speaking, some of the data points are volatile, like pending home sales. So this one happens to be printing slightly negative. But in general, housing recovered quite significantly. And that's, I think, fueled by, in part, demand being up because people are working at home. And so they're interested in making sure if they don't own a home that they feel comfortable in. There's been a big sort of surge of purchasing homes. In part, people are recognizing it while being at home, try to enjoy it and be comfortable. So increased demand, so think of it as away from the cities and into suburbs as people are sort of just building out their housing. On the business front, mixed to positive data here. So all kinds of data on this page. I think the categories include purchasing managers indexes. So those are surveys of businesses and management within businesses. And basically below 50 is contraction, above 50 is expansion. And what we see across the board is these numbers all shot up back above 50 and back to the pre-pandemic levels. We see some other things like CapEx orders, construction spending, which is sort of neutral to slightly positive. And then another one that's we watch carefully is the NFIB Small Business Optimism Index, which is up pretty strongly and certainly back to pre-pandemic levels. Here's an index that we've been tracking, corporate bankruptcy index. Obviously, you don't want that to be climbing. Earlier this year, it was climbing. It started to fall off again, really, as the economy started to heal in the wake of sort of coming out of at least the initial wave of shutdowns and so forth. And then the idea of businesses cutting or suspending dividends, this 67 for the S&P 500 puts it up in the neighborhood of the 2 years of the financial crisis. But this number has been reasonably stable for a couple of months or so. So we aren't seeing like dramatic continued action by companies, which we think is good. I've also said with this specific exhibit that I think in this environment, what we saw was these actions, either suspension or cuts, really as a conservative move to conserve cash. Oftentimes where the company may or may not actually be in quote-unquote trouble. So again, what we're going to get into here is that recovery has gone a little better than perhaps consensus expected. Now on the inflation front, basically we look at all kinds of measures. Remember, the Fed's target is 2%. All these measures are sort of floating well below that. It simply means inflation isn't up. It means that the Fed can continue its supportive policy. And they've also signaled that they're willing to let it go above 2% for a while to kind of make up for this amount of time that it's been below 2%. And so there's a lot of room for inflation to increase without the Fed having to take action to sort of stem it off and calm it down. Again, something we're watching, but as at present, inflation remains very subdued. Now, this dashboard is one that we put together early in the pandemic, and there are all kinds of data points here. I've talked about PMIs. On here you'll see manufacturing. You're going to see GDP, both here in the U.S. and globally. Anytime you see a green arrow, that means that the data point has recovered fully since pre-pandemic levels. So gone through the pandemic and has recovered. Those that haven't yet gotten there include sort of consumer sentiment, that type of thing, but importantly, of course, GDP. We're expecting contraction here in 2020, both in the U.S. and globally. These are a couple more data points here, obviously sort of tracking the coronavirus and the markets. And importantly, the equity market itself has recovered. So we'll see some data to that in just a second. Now, as it relates to sticking with the economy, we show this chart from time to time just to remind ourselves that big box on the right tells us that consumption makes up a big, essentially 2/3 of the U.S. GDP, and that means the consumers. The consumer matters a lot. We've talked about some of this, but confidence is recovered, but not fully. Retail sales is recovered. That's good. The employment environment, jobless claims has fallen, so that's good, but it's still not back down to the levels we saw pre-pandemic. And the unemployment rate basically has declined to 6.9%. That's much better than was forecast. I think it was almost a full point below the consensus forecast when that printed at the end of October. Another data point that's worth mentioning is that the Fed actually a couple months ago had forecast something well above this. I want to say above 8%. At the end of the year. So the fact that we're at 6.9% is still not great, but much better than originally thought. Now here's some data points. We know the Fed's monitoring things like financial conditions, which are pretty balanced at this point. We've talked about jobless claims, which got pretty bad but have been improving. And then interestingly, the forward-looking inflation, that five-year forward, so think of it as a 5-year inflation rate out 5 years. That's basically 2.17. That's a signal that the market thinks inflation by then will be increasing. Not much above the Fed's target, but still that's a good sign in our view. And then finally, the bottom left, the Atlanta Fed GDP now. This is an Atlanta Fed model that's just taking in real-time data and based upon the models calculating what it expects the next quarter's annualized GDP to be. And you can see it climbed up above 30% for the third quarter. We're going to get into that in a second. As of now, the fourth quarter has sort of come back down and is forecast to be 3.5%. We think it may end up coming a little higher than that, but that's the kind of the current Atlanta model forecast for fourth quarter. So here are those numbers. This is sort of a variety of shops, Stifel, our competitors, some research shops, and what people have been thinking through the 4 quarters of 2020. And the good news, as I've alluded to, is when we look at the third quarter recovery, that 33.1, that was well above the consensus forecast. In that first line, the 33.1. So that was very good news. What we see is a consensus view of 4% annualized for the fourth quarter, rounding out to a decline for 2020 of down 3.9%. And you can see, for example, the Fed currently forecasts GDP for 2020 in the U.S. to be down 3.7. So it's still not good to see contraction, but much better than originally forecast. Now let's turn to the markets. This chart we always like to show is basically the pattern of equity market returns. We've added a few things this year. First, we started and included 2019 to remind ourselves how good things looked last year. We came into 2020, things looked pretty good, and then we hit the bear market of 2020 associated with the pandemic. And what's interesting about it is if you look at the recovery, there's a couple lines I would point out. One is the equal weighted versus the S&P cap weighted index, the first 2 lines in the 2020 table. Basically that the cap weighted index did better, and then you can even see that FANG index, which is basically big tech stocks, up a lot more. Essentially what we saw was that the recovery was sort of dominated by the big tech companies, and just recently there's been a rotation away from that. So the participation in the recovery is broadening out, and so in recent periods, basically we're seeing the market do better than the more focused big tech, for example. Now, I mentioned we talk about recovery. This is a chart we like to look at just to remind ourselves, and this is every 15% decline since the late 1930s, I think, where the S&P was down, and then we see how long it takes to recover back to even, or actually this happens to be the 12 months subsequent to the fall. And anytime you see a green bar, that means that the market recovered earlier than that 12-month window. So this last one on the page is our current state, and it took 5 months for the market to recover. We were very focused on this as we were hitting the lows of 2020, but it's still a good reminder to know that the market for long-term investors tends to recover. Now this chart's one we pulled back out just to remind ourselves just how dramatic this experience has been with COVID, coronavirus, and the market's reaction. It was a much more severe and contagious virus. As a result, a bigger shutdown in terms of the economy and business activity and such. Market reacted very quickly and very negatively to that. And the good news is, as we've opened back up and seen recovery, things have come back. Now, we are obviously very focused on this next wave and the fact that certain local governments, states and local governments are starting to curb activity, putting in curfew, stay-at-home orders, limiting restaurants and gyms and bars and things like that. We'll see a little bit of a haircut as a result on parts of the economy, but the real open question is 2 things. One, have we learned how to sort of conduct business even with the virus? A lot more going on in terms of at-home orders, pick up food, that kind of thing. And then secondly, how quickly can we get vaccines deployed? So we're going to see almost like this wrestling match between those issues and the fact that the virus is spreading and it needs to be contained a little bit. So this chart reminds us that this bull and bear market cycle is with us through history. This happens to be what will likely be the shortest bear market in history, at least this window that we're looking at, and just how quickly it fell, how quickly it's recovered here in 2020. Now, this is an interesting chart. This is basically an index that was created capturing stay-at-home benefited companies. So think of it as video processing, or think of it as exercising at home, or maybe entertainment-based companies that people might take more advantage of if they're home. Basically that index, and there's been all kinds of indices developed in this pandemic to try to measure this. This happens to be one. Basically, when you look at that recovery from sort of the lows the bear market this year up until just recently. What a very, very strong return for those kinds of stocks. Not surprising, given that we're all sort of demanding those kinds of services more. And in a weird way, it's sort of a positive thing to see it turn over and move down a little bit. Why is it positive? That's basically a view that things are reopening and maybe we're not quite as dependent on these stay-at-home companies as before. But I will say, of course, we're very focused on the fact that the weather's turning. We're seeing some limitations, sort of soft shutdowns go into place. So there's a chance that some of these stocks will start to recover again. Now, here's a traditional look at valuation. I always like to remind people this is price to earnings ratio. So the question is, why would the blue lines price earnings jump up like this? And it's really driven either by the numerator going up, and remember, it's basically fell and then climbed back up, but then also it can go up if the denominator earnings goes down. So let's remember that in 2020 we've seen a decline in earnings for the S&P 500 and some of these other indices, and so it makes a lot of sense that the price earnings ratio, looking at the most recent and immediately forward earnings in both cases, has gone up a little bit. To do a reality check, this is the earnings yield compared to the 10-year treasury yield. Basically, you take the earnings yield, subtract the treasury, and plot it. And candidly, if the blue line is above the long-term average, that's viewed positively, meaning, hey, you're earning a better return than the 10-year treasury yield by a decent amount. That's the kind of thing that's keeping people interested in staying invested in stocks and supporting stock prices, basically. Now let's get to earnings, and I want to show you two charts. This one basically plots for the quarters, the 4 quarters of 2020, the view as of the beginning of January, as of the end of June, and now. And what we're seeing here is an interesting pattern where, of course, before we knew anything about the pandemic, things looked pretty good. We were expecting earnings growth. Then as things hit and we got into those sort of stressful times towards the end of June, the outlook was very negative. And you can see for the second and third quarter, basically these sort of soft gray bars, down big. And then the blue lines, basically, in the case of Q2, that is actually the earnings growth. Not quite as bad as originally forecast, but the drama is really with Q3. We're almost done reporting the full cycle of Q3, and it just has come in much, much better than expected. So to look at this chart, this is just a line that shows that same Q3 consensus forecast through time. So we started off the year innocent. All of a sudden, the pandemic hit. We get into April, May, June, July, August. There's a lot of negativity. And then as we've made our way through this earnings season, if you will, for third quarter, essentially what we're finding is, in round numbers, earnings are down 8% year over year for third quarter versus what was forecast down to be, I think over 25%. So not good, but much, much better than originally expected. Now, here's why. So here's basically the percent of companies that ended up beating their consensus earnings forecast. And you can see typically stocks do a little better than forecast. So on average, 65% end up beating that green line there across. That's the average. But if you look at the most recent, 84% of companies so far in the S&P are beating third quarter earnings. And so, and you actually see a similar number for second quarter, much, much better than expected. And the magnitude is quite striking. Basically, the amount of surprises is almost 20%. So think of it as you're going along and all of a sudden the earnings are 20% better than the consensus view expected. That's a positive result. Another reason equity markets have remained sort of supported. Turning to interest rates kind of quickly here, you can see this chart, which we pulled back out. The upper left is the Federal Reserve, the Fed funds rate. Basically, you can see that stepwise function where they raised it for a while, then in 2019 cut a few times, and then with the pandemic just brought it right down to essentially zero. So very, very common in Fed policy. At the bottom are basically spreads. That's the earning for both investment grade and high yield that you get above treasuries for investing in the bonds. And with the risk and uncertainty of the pandemic, those spreads widened out quite significantly. Think of it as the mirror image of the stock market. And then since then, they've calmed down quite a lot. They're still above where we were pre-pandemic, but things have calmed down a lot. Then finally, interest rates. When the Fed drops rates down, and it's expected they'll stay there for a while, the Treasury rate curve falls down significantly, which it did. And I think it's important to note that as we've seen this recovery, things better than expected, interest rates are starting to climb higher, especially the 30 and the 10-year, as compared to shorter term rates like the 2-year. And so that's also good, because what we're seeing is the yield curve steepening a little bit, which is healthy for investors and healthy for financial companies like banks, for example. So we actually think this increasing interest rate pattern is a positive. Now, I wanted to mention in this particular strategy brief video that we have made a change to some of our dynamic leanings. So this is a framework just to remind everybody of how we think about asset allocation. We'll guide clients across the risk spectrum from conservative to aggressive. Kind of the financial advisor, our financial advisors will get to know their clients, understand where the client might sit on that risk spectrum, and then oftentimes anchor on an asset mix across their investments that basically are similar to this idea of how much in stocks versus how much in bonds. The more aggressive, the more in equity. The framework in any event includes sort of an ability to invest either in a global approach with equities or a U.S.-focused approach, to invest in tax-sensitive bonds or taxable bonds, meaning munis or taxable bonds. We have 3 levels of liquidity that basically relates to introducing some forms of alternative investment for the slightly less liquid Tier 2 and Tier 3. And then we have 2 different time frames. We anchor on a long-term strategic view. We're always talking about being a long-term investor. But for some clients, they then want to, against that strategic view, dynamically lean in and out of styles or markets or whatever. And so this month we did make an update to our dynamic leanings. And this next page basically focuses on where the changes are, which is the equity market. I'll remind our listeners that we had basically had a structure that we sort of unwound a few months ago and went back to neutral. We were a little overweight growth stocks, for example. We went back to neutral in anticipation of this rotation we were talking about. And this time around, what we're doing is going modestly overweight large value stocks in the large cap space and modestly overweight small cap core, so small cap overall, in anticipation of this cyclical recovery in both cases. When it comes to non-U.S. stocks, we've left ourselves neutral both in terms of how much we allocate there and how we balance between in developed and emerging markets. And then within fixed income, we remain neutral. But the kinds of things we're looking at, we're going to continue to look at emerging markets. We're going to continue to look at high yield. And then for those that are invested in alternatives, we recommend sort of a strategic allocation given the less liquid nature of many of the alternatives. So that's it for this month. I wanted to remind people in the video link here, there's in turn a link to the slide presentation. And I'll just close to mention that we always like to include Stifel guidance on this final page. These are hot links to different things that you can check out, daily pieces, weekly pieces, this monthly video, etc. So we would welcome everyone to kind of check out all that work. Thanks so much, and we'll look forward to catching up with you next month.